Hello and a very warm welcome. On behalf of everyone here at Pro Tax Accountant, we're going to be walking you through one of the UK's trickiest tax rules, the pre-owned assets tax. Now, this is a topic that trips up so many people planning their estate, and if you get it wrong, it can lead to some really nasty, unexpected costs. So in this guide, we're going to break it all down into simple, clear terms so you can plan for the future with total confidence. Let's get started. It sounds a bit weird, right? But the answer is yes. You absolutely can be. You can be taxed on something that you don't even own anymore. This is the exact reason the pre-owned assets tax, or POAT for short, was created. It's basically an anti-avoidance rule from HMRC, and it's designed to catch some very specific arrangements that can trip up even the most careful planners, sometimes years and years after a gift was made. So to make sense of all this, we've broken this guide down into 5 key parts. First, we'll look at why this tax even exists, the backstory. Then, we'll help you figure out if you're actually at risk. After that, we'll get into how the charge is calculated, look at your strategic options to manage it, and finally, we'll weigh up the big choice you might have to make between POAT and inheritance tax. Okay, so let's start with Section 1, the backstory. You know, to really get your head around POAT, you first need to understand the UK's rules on gifting. It's been a bit of a cat-and-mouse game between savvy estate planners and HMRC for decades, and POAT is one of HMRC's biggest moves in that game. Now, a lot of us have probably heard of this one, right? It's a fundamental rule of inheritance tax, or IHT. You make a gift, let's say it's a house or a chunk of cash, and as long as you live for 7 years after making that gift, it falls completely outside of your estate for tax. Seems simple, a clean break, but well, HMRC noticed that people were getting a little too clever with this, following the letter of the law, but maybe not the spirit. And that's where this older rule comes into play. It's called the gift with reservation of benefit rule. What it basically says is, for a gift to be a real gift in the eyes of the taxman, you have to completely give it away. You have to sever your ties to it. So if you gift your house to your kids, but you carry on living there rent-free, HMRC says, hang on, you're still benefiting from it, so for tax purposes, it's as if you never gave it away at all. Honestly, this is the perfect way to think about it. People tried to find all sorts of clever ways around that gift with reservation rule. For instance, instead of gifting the house, someone might gift cash to their child, who then uses that exact cash to buy a house for the parent to live in. See the trick? Technically, they hadn't reserved a benefit in the asset they gave away, which was the cash. So POAT was brought in back in 2005 specifically to slam that door shut. So we know why it exists. But the next massive question is, are you at risk? This is where we get practical. Let's jump into our next section and see if this is something that should be on your radar. POAT casts a pretty wide net, and it covers 3 main categories. First up, the most common one, land. We're talking houses, holiday cottages, even a plot of land you still use. Second is something called chattels. That's just a fancy word for your tangible, movable stuff. Think valuable things like a classic car you still take for a spin, a piece of art hanging on your wall, or expensive furniture. And third, intangible property. This is where it gets a bit more complex, often involving things like cash or shares that have been put into certain types of trusts where you might still get some benefit. So what are the red flags? When does this tax actually kick in? Well, first, you had to have gotten rid of the asset sometime after the 17th of March, 1986. Second, and this is the absolute key, you continue to benefit from it in some way. Third, simple. Outright gifts between spouses are usually exempt, which is good. And fourth, it can also catch you if you didn't gift the asset itself, but you gave someone the cash to buy it, and now you're enjoying it. It's a wide net for sure. Okay, here's a pro tip, especially for any small business owners or freelancers out there. Let's imagine a guy called Alex, a graphic designer in London. He puts a big chunk of cash into a trust for his kids as part of his estate plan. Then, the trust buys a small flat in his building, which Alex starts using as his studio, completely rent-free. Even though he gifted cash, not the flat, his use of that studio is seen as a benefit from the original gift. Bang, that could easily trigger an unexpected POAT charge. It's a really common modern-day trap. All right, so you think you might be caught. The next logical question is, okay, what's the damage? How much is this going to cost me? And it's not a one-off hit, it's an annual income tax charge. So let's get into the numbers. Let's use an example. It makes it so much clearer. Meet Marjorie from Manchester. A while back, she gifted her £500,000 home to her son, but she still lives there, paying no rent. Okay, so for the 2025-26 tax year, we figure out the market rent for a house like hers would be about £15,000 a year. Since Marjorie pays zero, that whole £15,000 is treated as a taxable benefit. This gets added to her income for the year, and if she's a basic rate taxpayer at 20%, well, that's a £3,000 tax bill she has to pay every single year. Now, there is a bit of good news, and it's this number, £5,000. See, HMRC isn't bothered about tiny benefits. There's what's called a de minimis exemption. Basically, if the total annual benefit you get from all your pre-owned assets comes to less than £5,000 in a tax year, you don't have to pay any POAT. But be careful. It's a cliff edge. If the benefit is £4,999, your tax is zero. If it's £5,001, you pay tax on the whole amount.
Knowing the problem is one thing, but how do you fix it? This isn't just about handing over the cash. It's about making smart choices. So in this next section, let's explore your options for legally managing or maybe even getting rid of a POAT charge altogether.
Think of these as your mean escape hatches. We've already talked about that crucial under $5,000 rule and the spousal exemption, but the most direct strategy is simply to pay for the benefit you're getting. If you pay a full commercial market rent to the new owner, your taxable benefit drops to zero. And of course, there are some other excluded transactions, like assets transferred during a divorce, that are also exempt. Here's a brilliant little did you know for you that shows how a small change can have a huge impact. Let's take Gordon from Glasgow. He gifted a valuable antique clock to his daughter, but kept it on his mantelpiece. HMRC decided the benefit of enjoying that clock was worth £3,000 a year, which meant a £600 tax bill for Gordon. The solution? So simple. He just moved the clock to his daughter's house. By doing that, he stopped benefiting from it. And just like that, the tax charge for the next year was gone. Right, now we get to the really big one, the most advanced strategic decision you might have to face. If you're caught by the POAT rules and you can't use an exemption, you're not stuck. You have a choice. It's a major fork in the road. You can actually make a formal choice to opt out of paying the yearly POA charge. The trade-off is that the asset gets pulled back under those gift with reservation rules we talked about at the start. So which is better? Well, it's all about the numbers. Imagine the asset is a house worth £1 million. The potential inheritance tax hit at 40% could be a massive £400,000. If the annual POA charge is, say, £8,000, you'd have to live for 50 years for the POA to add up to that. In that case, paying POA every year might be the smarter move. But if your total estate is way under the IHT threshold, then taking a potential IHT hit that might never even happen is much smarter than paying income tax year after year. The practical step here is filing a Form IHT 500 with HMRC, and there are strict deadlines for it. But look, this is a huge decision. You're swapping one tax for another, and the long-term consequences are massive. It depends on your age, your health, the asset's value, the rest of your estate. This is exactly the point where getting professional, tailored advice isn't just a good idea, it is absolutely essential. Okay, let's boil all of that down. What are the key things to remember? First, POAT is an income tax you pay on the benefit you get from stuff you've already given away. Second, it covers land, valuable items, and certain trusts. Third, the tax is based on the market value of that benefit. And finally, remember your options. You can pay market rent, hope the benefit is under $5,000, or choose to have the asset treated as part of your estate for inheritance tax instead. So after all that, this brings us to the big question for you to think about. Is your estate plan actually tax-proof? Just take a moment. Think about any gifts you've made in the past. Are you still benefiting from them, even in a small way? Answering that question honestly now could save you a world of hassle and a big tax bill down the road. If anything we've talked about has raised some questions or you're just not sure where you stand, the absolute best thing to do is to get professional advice. The team here at Pro Tax Accountant lives and breathes these complex rules, and they can give you advice that's tailored specifically to you and your family. And it's really easy to get in touch. You can WhatsApp them or call them directly on 07-985-689912. Let me repeat that, 07-985-689912. Or, if you prefer, just send an email with your question to info@protaxaccountant.co.uk. The team is ready and waiting to help. And finally, if you found this guide useful, please do hit that subscribe button for the Pro Tax Accounting YouTube channel. We've got loads more clear, simple guides on UK tax to help you stay informed and feel confident about your finances. Thanks so much for watching.